$3,000 of market decline is not a $3,000 tax loss harvesting benefit. A sale changes the question. By the end, you will have one test. Does the replacement still fit after a sale creates the tax paperwork?
And before anyone treats this as a recommendation, we're teaching the mechanism. We aren't choosing a security, telling you to sell, or calculating your return. Rowan is a hypothetical record, not a model portfolio. The numbers exist to make the workflow testable. They don't encode a forecast, a suitable allocation, or a filing position.
Start with the record. The IRS describes capital gain or loss as the difference between adjusted basis and the amount realized on sale. That means price movement alone is unfinished information. A sale creates the event that can produce a realized gain or realized loss. The record still needs the correct asset, lot, dates, quantities, proceeds, and adjusted basis. A dashboard percentage can't substitute for that chain.
That distinction prevents a common category error. If Rowan bought an investment for $10,000 and its quoted value falls to $7,000, Rowan has a $3,000 decline in market value. Until a sale occurs, that example has not created the sale record this lesson is about. Markets can recover or fall further before Rowan acts. The quoted decline explains current value, not a completed transaction.
Erica, the first question isn't how much red appeared. It's whether a sale happened and what the paperwork shows for basis, proceeds, fees, and adjustments.
Right, then the investment question returns. Selling changes what Rowan owns. If Rowan still needs the same long-term exposure, the next position must fit the plan without pretending two investments are interchangeable.
Here's the clean split, Elena. Tax paperwork asks what happened in the sale, while portfolio planning asks what exposure disappeared and what should replace it. One decision can touch both columns, but neither column answers the other. The paperwork side is historical. What did Rowan own, sell, and receive? The plan side is forward-looking. What risk and return pattern should the money serve now? Mixing those time directions creates false confidence.
No tax victory lap.
That objection survives. The practical value is narrower. A realized loss may become relevant when capital gains and losses are reconciled under current rules. It doesn't erase the economic loss, and it doesn't prove the sale was wise. A useful comparison includes expected portfolio behavior, transaction costs, time out of market, and reliable paperwork. Tax treatment is one input among several. The sale side review asks whether the paperwork is complete enough to describe a transaction. The plan side review asks a different question. After the sale, what concentration, diversification, liquidity, and risk exposure remain? A person can have accurate basis information and still make an investment change that no longer fits their horizon. The reverse can also happen. A sensible portfolio adjustment can be described badly if the lot history is incomplete. Keeping those two reviews separate gives a broker, a plan professional, and a tax professional the part each can actually evaluate.
History's verdict is brutal on tidy tax explanations attached to messy investment decisions. People remember the deduction and forget the position they abandoned. The sequence should run the other way: plan first, tax consequence second, paperwork throughout.
Rowan needs a before and after sheet. Goal, time horizon, risk, current exposure, replacement exposure, transaction cost, and the tax question to verify. If one line is blank, the decision isn't finished. The point is not to turn one checklist into permission to trade. It is to stop a tax phrase from jumping over the investment decision. If the replacement is unclear, write that uncertainty down instead of treating the loss amount as a reason to solve it quickly. A disciplined pause can preserve both the portfolio question and the documentation trail.
My opening rule is simple: never sell only because the tax label sounds sophisticated. First, decide whether the investment change fits the plan. Then verify the tax treatment with current official guidance and, when personal facts matter, qualified help. Which record would you open before calling a loss a tax benefit? And Lewis's question is exactly where we go next. A $3,000 loss is a record amount, not an automatic tax benefit. Coming up, Professor Kowalski shows why the headline must face the complete annual picture. Quick honest ask while we are here. If this has been worth your time so far, hit like, then subscribe and ring the bell. I know everyone asks, but this one is free, and it is how a small channel like this actually grows. Professor Kowalski, That's the point. Rowan's $3,000 realized loss establishes a record, not a personal savings figure.
It establishes a capital loss record to reconcile. It doesn't establish a personal tax savings figure. The result can depend on other gains and losses, account type, current law, filing facts, and whether another rule limits the loss. It also doesn't tell us whether Rowan should have owned, sold, or replaced the investment. Those are separate judgments with separate evidence.
So the calculator gets demoted from Oracle to evidence clerk.
Good demotion. Use the illustrative numbers carefully. Rowan's adjusted basis is $10,000 and amount realized is $7,000. Before any other adjustment, the simple difference is a $3,000 realized loss. That's the record amount in our example, not a promised tax refund. We have not supplied Rowan's other transactions, filing position, account history, or replacement activity. The receipt is intentionally incomplete as a personal tax answer.
$10,000 of basis.
$7,000 realized. The illustrative difference is a $3,000 loss.
Erica, now repair the question. Don't ask, what is this loss worth? Ask where this realized loss enters the person's complete capital gain and loss picture under the rules for that year. That is where a real answer begins.
Then capital losses always wipe out ordinary income dollar for dollar.
No, that skips the rule. That sentence jumps over ordering, limits, carryovers, and the person's whole return. A broad slogan has no filing year and no facts. Its tax content shaped like a fortune cookie. Lewis, the better question is where this realized loss enters the complete capital gain and loss picture.
The defensible lesson is that capital losses may offset capital gains. Any additional treatment must be checked against current IRS rules and the person's circumstances. We will not turn a general concept into a filing instruction. Rates, limits, ordering rules, and carryover questions can be time-sensitive. That's why an undated shortcut is especially weak in tax education. The owner of each answer matters here. A broker can explain confirmations, lot displays, and what its platform reports. A tax professional can evaluate how a complete set of personal facts may affect treatment. Neither role replaces the investor's job of identifying the transaction, preserving the source paperwork, and asking a bounded question. That handoff prevents a viewer from asking a broker to predict a return or asking a video to settle a filing result.
And timing matters. A loss is measured in a transaction record, while its tax use belongs in a larger annual reconciliation. The value can change when the surrounding gains, losses, account rules, and other transactions change. That's why two people can make economically similar sales and still need different tax answers.
When this breaks, use a bounded workflow. First, preserve the trade confirmation and basis paperwork. Second, list the realized amount without calling it tax savings. Third, reconcile other capital transactions. Fourth, check current official rules for the filing year. Fifth, take account-specific or return-specific questions to the broker and a qualified tax professional. That sequence creates useful questions without pretending an educational example can see a viewer's entire return. A calculator is like a well-made boot, useful when it fits, but it cannot walk the route for you.
Call it the loss ledger. The number enters. The surrounding facts decide what the number can do. Give each line a source document and a date. If Rowan can't trace the number back to the confirmation and basis record, the ledger is a draft, not evidence.
That name works if the ledger also records dates. A loss amount without purchase and sale dates is missing a control field. Before we get to replacement choices, the next scene shows why the window reaches backward and forward.
And that date is the pivot. One rule reaches backward as well as forward.
"30 days before and 30 days after." The IRS wash sale window reaches in both directions around a lost sale.
That first half surprises people. They look only for a repurchase after the sale, but an acquisition before the sale can also fall inside the window.
The official rule is more precise. A wash sale can occur when stock or securities are sold at a loss and substantially identical stock or securities are acquired within 30 days before or after the sale. The day of sale anchors the test, and account-wide records matter. The word acquired reaches beyond a deliberate manual buy. Recurring investments and reinvestment settings deserve inspection too.
Here's the visual boundary: 30 days before, the sale date, and 30 days after. That's not a promise that every purchase in the span is a wash sale. It's the period that tells you where to inspect the hero.
Different ticker doesn't settle it.
Exactly. Similar isn't automatically identical, and a different ticker isn't automatically safe. The IRS says the answer depends on all facts and circumstances in the particular case. That language resists a universal product list. An educational channel should not turn a judgment standard into a shopping menu. The loss ledger from the desk needs 4 date fields: original purchase, lost sale, any acquisition before the sale, and any acquisition after it. Then scan every account where the person or household can trade, including automated purchases that are easy to forget. Add security identifiers, quantities, and account ownership where available. The goal isn't to decide the rule from a homemade sheet. The goal is to surface every transaction a qualified reviewer may need.
Elena has the dates in view. Watch this worked classroom slide. It illustrates the basis mechanism. The IRS remains the authority for the rule.
The disallowed loss does not simply disappear. It generally moves into replacement basis, postponing the deduction until that replacement is disposed of. Today's loss treatment and the replacement lot become linked.
So the wrong mental model says the loss vanished. The better model says the loss was deferred into a basis adjustment. That changes the later record, which is why preserving the replacement lot details matters.
Elena's timeline is the right setup for the worked classroom slide. Watch how the disallowed loss moves into replacement basis. The IRS remains the authority for the rule.
I catch myself filing this like a village pub history. Dates first, claims second. The statement, confirmation, lot history, and automated purchase record belong together. Those dates tell you which documents belong beside the basis figure before anyone classifies the result.
Build the calendar before building confidence. A recurring dividend reinvestment, a purchase in another account, or a spouse's transaction can create a question the main brokerage summary doesn't answer by itself.
The medium-level takeaway is not memorize a slogan. It is inspect the full date window, identify potentially substantially identical acquisitions, preserve replacement basis, and verify the conclusion under current rules. The audit has to be account-wide in the practical sense. Do not stop at the one screen where the lost sale appears. Look for scheduled purchases, dividend reinvestment, workplace plan activity, related household activity, and other locations where a potentially relevant acquisition could occur. That does not mean every activity creates the same result. It means the reviewer needs the whole map before deciding whether the substantially identical standard applies. The phrase is deliberately fact-specific, so a different name, fund family, or familiar label cannot be treated as a universal answer. The useful output is a dated set of documents and a question precise enough for a qualified reviewer to investigate.
Which account and date could change this wash sale check?
One timeline, one defensible question.
Professor Kowalski, welcome back. The wash sale window is clear. What about staying invested?
That's a portfolio question before it's a tax question.
Selling removes exposure. Cash is a position too, with its own opportunity cost and timing risk.
So buy the closest substitute immediately.
No. That's my lane. Closest for portfolio behavior may raise the tax question you were trying to control. Farthest for tax comfort may break the investment plan or create a risk profile Rowan never wanted.
Exactly. The replacement must survive both reviews before anyone calls the tactic successful.
I was optimizing one column.
Right. Separate the columns before choosing, then make every assumption visible enough to challenge.
And don't confuse similar market behavior with a legal conclusion about identity under the tax rule.
Different ticker, automatic safety.
No, facts and circumstances still control, including what the two holdings actually represent.
Same fund family, automatic failure.
Also, no universal answer from this desk. The family label doesn't settle the holdings comparison.
That's the edge case answer. Verify the actual holdings and current rule. Don't guess from labels.
Check taxable accounts, retirement accounts, spouse activity, dividend reinvestment, and every automated purchase schedule.
Elena's loss ledger just became a household timeline because one visible account isn't the whole record.
My term. Your upgrade.
Now the promise from the opening. Replacement fit can matter more than the harvested loss amount itself.
Because a tax tactic can't repair unwanted exposure, an unsuitable risk level, or a broken allocation.
Or the opportunity cost of time out of the market while the plan waits for an answer.
Or transaction costs, spreads, and drift created by trading that serve the tax label instead of the plan.
Use 4 owners for 4 answers.
The broker explains its records and platform behavior, not the complete treatment of your whole return.
The tax professional analyzes personal facts and current rules, not whether the replacement suits your investing goals.
And current official guidance outranks a catchy shortcut, especially when the shortcut has no date or source.
My verdict: harvest only when the sale fits the plan and the replacement survives a wash sale review.
Tax value is a possible benefit, never the entire thesis. Send this to the person who thinks a red position automatically creates a tax win.
Professor Kowalski, thank you. I second the verify first rule.
Keep the dates and replacement basis. Memory isn't a record. A rulebook beats a clever shortcut.
If this made tax loss harvesting clearer, like the lesson and subscribe to Investing Explained. Which part would you verify first? The sale record, the date window, or the replacement? The bottom line: the plan writes the first line. The tax tactic only follows. Take care.